This video covers a few methods of working out the size of your home loan you can afford. But we also suggest you start by using the Tella Home Loan Affordability Calculator. It's linked below in this video. A few quick rules of thumb around affordability are multiple of income. For this, you take your total income and multiply it by 6. This gives an indication of how much you can borrow. For instance, if you have a total joint income of $200,000, you could potentially borrow up to $1.2 million. Your monthly expenses, such as any personal loans or higher than normal living costs, will reduce this amount. Payments as a percentage of income. Fixed payments, such as monthly mortgage repayments, plus any other loan or hire purchase repayments, should be no more than 40% of your total monthly gross income. To work this out, you work backwards. Total up your salary, then total up your loan repayments to determine the maximum home loan repayment a lender will accept. You may then try to work out different loan sizes to see what you can afford with these repayments. What's left over? This is the most common assessments the banks use. Lenders also consider a minimum amount, referred to as a minimum surplus or uncommitted monthly income, that should be left over each month after all fixed payments and living allowances are deducted. The acceptable amount varies from bank to bank. The estimates for a couple are based on their joint income, and lenders expect to see a smaller surplus from someone with children. Loan to value. All New Zealand banks are governed by the Reserve Bank, and they specify that each bank holds no more than 10% of their loans with a loan to value ratio greater than 80%. This means that even if you can afford to borrow more than 80% LVR, you're not guaranteed a loan approval, as it depends on how many other loans are held by the bank above 80% lending.